Hello, everybody, and welcome into Commodity Culture, where we break down commodities markets, sound money principles, and geopolitics, all with the goal of making you a better investor in the commodities sector. My name is Jesse Day. Today is February 20th, 2026, and I'm thrilled to be joined by Josef Schachter, a noted oil and gas analyst focused on the Canadian oil and gas sector and the author of the Schachter Energy Report. Josef goes deep today on breaking down the latest developments in the energy space, including how military action in Iran could affect the oil price, the recent Supreme Court ruling against Trump's tariffs and the impact it could have on energy, why Canada isn't as risky of a jurisdiction as many are making it out to be, why he thinks we're ultimately headed to new all-time highs for oil, his take on natural gas, and why he's especially bullish on that sector, and so much more. So strap yourselves in for my conversation with Josef Schachter. Josef Schachter, it is great to have you on Commodity Culture. I want to kick things off with a broad overview of the oil and gas sector at present, because it's largely been ignored over the past several years by the mainstream financial press and institutional investors amidst narratives of peak oil demand coming and EVs taking over the world. Is this sector presenting an opportunity for contrarians right now? And what are your overall thoughts on the health of energy markets today?
Well, the energy markets, have go up and down when there's excess supply or there's, and if there's periods when you don't have enough. So, for example, we're right now around 90 days of supply, which is about normal for this type of economy, growing at 1 or 2%. If you go back to COVID, inventories went up to 120 days because demand just fell off the cliff. The tightest period we ever had was in 2008. If you remember, we went from $90 to 147 from the beginning of 2008 to the summer of 2008. And that's because we went down in days of inventory to 79. So we're right where we should be. So the key thing is demand growth. Right now, we believe it'll be 1.2, 1.3 million per year. It may not be much in the OECD, because of EVs, environmental rules, especially in Europe. But where the demand growth is going to come is from the third world. That's where we're going to get the copper, the lithium, the zinc, the nickel, copper, all those things that are needed for the grid, for the AI world, and for them to put on new facilities in the Congo, in Zambia, and other places. If it's nickel, it's Indonesia. They need to spend a lot of money to build it, and they need to have return on that capital. The governments need to see a return on getting the resources out of their country. And the people who do the work and the people, living in the area need a good standard of living. Remember, of the 7 billion people in the world, 2 billion people do not have running water in their homes. They don't have electricity. And so those are the people in most of the countries we're talking about that are going to bring on those raw materials we need. And so the demand that they're going to have for energy, be it natural gas, be it coal, be it oil, is going to rise. They're going to want to go from bikes to scooters to cars to trucks, just like we have. They want our standard of living if they can. And so I think that's really the driving force for this cycle. In the 1970 cycle, we had Japan coming out of from being just a minor industrial economy, but then they started building cars, Toyotas, Datsuns, all the rest of it, Panasonic, Sony's, and their economy increased the consumption of energy as they built out those export industries. And that's how you started seeing the price of oil go from under $3, and it peaked to 36. Again, the last part of it from 28 to 36 was Iran. The Shah of Iran was deposed. So Iran comes into the picture again at that time. And of course, it's in the picture now. The 99 to 08 was China had 4 million barrels of production and consuming less than that. And they all of a sudden said capitalism under a communist umbrella. And they ran up to 14 million barrels of consumption by 2008. Now they're about 17 million barrels of consumption. And that was the driving force there. Where I see the big increase in consumption coming is the third world. And that could be 10 or 15 million barrels over the next decade. But the OECD numbers will flatten, and the big increase will be the non-OECD, the emerging world. And that's really the bullish case, and why I think the industry needs to have a price in the 80s or 90s on a consistent basis. Right now we're 64, 65. I think we might back off if there's no Iran thing because there's a war premium in there. But I think heading into Q2, I think it's going to be clear that the OPEC countries do not have the ability to raise production materially. We can spend time on that. And in Q3, it'll be very clear that the days of inventory globally are coming down because the United States has already taken over Venezuela's shadow fleet. And so the only shadow fleets are Iran and Russia. And of course, we'll see if demand growth picks up, then those shadow fleet inventories will come down. If you want to look at, the big one that matters is the United States. The EIA every week, the Energy Information Administration of the United States, gives you the weekly petroleum status report, but they put a chart in there on the U.S. inventories, and it's a band of 5 years, and it's at the lower end of that band. So the biggest industrial economy that's, consuming about 22 million barrels, produces around 24 million barrels, their inventories are at the lower end because they are exporting the light oil from the Permian and the Eagle Ford. And that is really where, the United States is in a very enviable position because they are self-sufficient. Canada, of course, is self-sufficient, and we're a big exporter. We export about, 3.5, 4 million barrels a day. We produce 6.1. So we're in a very enviable position. And the question is, can we grow our business and can we get more infrastructure to the West Coast? That's a discussion of its own. And again, our premier in Alberta, Daniel Smith, is saying we need to get a 1 million a day pipeline to the West Coast because if Venezuela production rises sharply, they're going to take that oil into the U.S. Gulf Coast, and that means Canadian heavies will be displaced, and that's a big problem longer term. So we need to find export capacity either in the West Coast, TMX expansion. Do we have a pipeline that goes to Alaska? Does Churchill become an option? Do the Great Lakes become an option? But the bottom line is we will need, by the end of the decade, another 1 million barrels of takeaway if we want our Canadian oil industry to grow. Fortunately, our new government in Ottawa is becoming more pro-natural resources, not only energy, but mining. People have to take into account that of our export industries that create our export surpluses, energy is the first, precious metals is the second. So quite a shock to people to realize that two of our natural resource businesses are our most profitable. It's not Ontario and Quebec auto industry or manufacturing. It's the resource sector. And remember, forest products is another big one for us in terms of shipments of pulp and paper and all of those lumber. You remember all the problems with tariffs on lumber in the United States. So we're waiting to see what happens with this tariff issue. Right now, Supreme Court has ruled that they can't apply it. So we'll wait and see, what the president does, and does he need to get Congress support? And fortunately, with him now having still the Senate and the House, maybe they can get something through that allow it to, but again, that's a totally different subject to what we're talking about today.
Yeah, so much there that I'd like to unpack. Let's start with the potential for an attack on Iran. First of all, how likely do you think such an attack is, given the massive military buildup by the U.S. administration around the region, the threats coming from the Trump administration, and Iran seeming to be unwilling to come to terms with what's on the table at the moment? And secondly, how do you think this could impact the oil price? Because a lot of people I've spoken to say that usually these sorts of geopolitical shocks, such as a hot war starting, are generally a short-term driver for the price of oil and don't necessarily create a sustained change to the upside in the oil price. Could this time be different? And how do you see all of that playing out?
Firstly, if you look at the Iran situation, there's a number of issues the United States has on the plate. Number one, of course, is the nuclear weapons and the nuclear enrichment issue. Second, it's ballistic missiles. Right now, they have medium range, which can hit Europe, Israel, and a lot of the Middle East. They're building the capacity with help from Korea, North Korea, and Russia to go and have long-range capacity to the United States. That's a no-no from the point of view of U.S. security. Thirdly, support of terrorism. They've still got the Houthis in Yemen being bad boys in the area. And then lastly, It's the issue of, killing their own citizens who are protesting in the streets. And is it thousands or tens of thousands? We just don't know. But that's an issue. So I think the Iranians are talking about maybe allowing some of their enriched uranium to go to Russia, but they're not willing to give up the program. They're not willing to do anything on the other issues. So I think military action is likely. There's a lot of reports saying the U.S. could go as early as this week. Other reports are saying the president has offered 10 or 15 more days. But again, he did the same with Maduro and went in earlier. I think the first thing they need to do is take out the anti-air, SAM missiles like they did in Venezuela, so the planes can go in without having the risk of being shot down. I think they need to degrade the IRGC, which is the Iran Revolutionary Guard that keeps the mullahs in power. They need to be degraded, and they are right now stronger than the conventional military, the Atash. They need to take down their naval assets. If you remember, they did a little blockade of the Straits of Hormuz just a few days ago with Russian help, and so that has to be degraded. And then they need to degrade the IRGC equipment, both air and land, be it tanks and other weaponry, so that the Atash could say, we're supporting the people, and the general military would say to the IRGC and the mullahs, this has gone on too long. We don't want you running it. They won't go for democracy, but they'll definitely say, we're not letting you run things the way you were, and we will not oppress and kill our own people. So I think something will happen. How quickly, I don't know. But I think that if it happens, it could be a multi-week situation. And that's why you have 2 aircraft carriers, a lot more planes, and a lot more equipment in the area. And the military did such a superb job in Venezuela. They probably have lots of plans on what to do, minimize casualties in the area, minimize casualties of American forces. And I think the problems of Afghanistan and Vietnam are behind us. The U.S. military has changed a lot, and I think we'll see some action that I think will destabilize the mullahs, and that they will. They've already sent billions out of the country so that they have a hiding place with some money. So they're already preparing for the eventual negative outcome. And my view is, at some point, it may take some time. It may take different levels of stress or an attack. But I think in the end, we will see some action that will be favorable to the Iranian people.
The sponsor of today's episode is ARC Silver Gold Osmium. Owner Ian Everard is praised even by his competitors as one of the most honest and level-headed bullion dealers in the United States. They have some great prices. You can see some of them displayed right now on screen. Take advantage of these specials today by reaching out to Ian at 307-264-9441 or by email at ian@arcsgo.com. Make sure to tell him, of course, that Commodity Culture sent you. And now, back to the interview. And your thoughts on how it could affect oil markets?
Well, if you look at when Russia invaded Ukraine, the price of oil popped to 120, and then it backed off fairly quickly because there was no issue of supply, and sanctions just did not work. Russia is still producing about 9.4 million barrels a day, and China's become the big buyer, even though India and others have not been buying their crude. If we look at Venezuela, they were producing 3.5 million before Chavez took over. They were down to 600,000 with American sanctions, and then they're now back to almost 1 million barrels a day under American sales auspices. And the buyers are U.S. Europe is a buyer. China is a buyer. And the price they're getting is not $40, where there was, let's say if the price of oil was 60, they were selling it at 40, so $20 discount. Now it's only the quality discount. So if you're $65 minus 15 for the quality, because it's heavy oil and it's sour and, all the things you need to do to upgrade it and get the products out of it that you want. But if they're getting 50, that's still, from 40 to 50 is a big increase. And that money goes into U.S. Treasury now. For a while, it went to banks in Qatar. Now it goes into the U.S. Treasury. And then the U.S. Treasury says to Venezuela, give us a shopping list of items you want from the United States, food, medical, other things that you want. And if we approve them, we'll send you the goods.
Well, let's break down Venezuela as well, because as you mentioned, Premier Danielle Smith in Alberta being concerned about the potential for production to be ramped up there, wanting to increase infrastructure, get the pipelines built. So I do actually want to dive into the Canadian side of things in the moment. But first, some analysts have said on the Venezuelan side that actually there's not much chance of increasing production by a meaningful amount there, at least in the short term, considering the amount of infrastructure needed, the expense of building that infrastructure, the time it would require, and people like the CEO of ExxonMobil expressing concern about returning to the region because of expropriation of assets in the past. So help us separate the signal from the noise when it comes to Venezuelan oil production and its potential impact.
Well, starting with Exxon, they had their assets expropriated twice. So, you burn me twice, don't burn me a third time. At least I learned my lesson. So Exxon will not be going in. Chevron is there, and they consistently stayed there with State Department approval, U.S. State Department approval. And they were producing about 250,000 in partnership with PDVSA. And they were taking half of that and bringing it into the United States. And they were bringing diluent into the country to move it under the auspices of the State Department. Now those regulations have been removed. The U.S. State Department and the government of the states have said we will allow Eni and Total and Chevron and everybody who wants to go back in, who has the skill sets to go back in. And then on the service side, Schlumberger, Halliburton, Baker Hughes, they can all go back in. So people say, oh, it's going to take a long time. Some people say you might see, 1.5 million by the end of 26 and maybe a million, 1.8 to 2 million when you have to build infrastructure by the end of 27. But take into account what happened in Kuwait. When Saddam Hussein was pushed out of Kuwait, he blew everything up. But Kuwait within a year was back to full capacity. So if the industry is allowed to go in and the rule of law is there, and the companies know that they'll get paid. The oil and gas industry, the companies that go in know that they'll be able to have, ownership of the assets and that they can, get cash for them when they sell them. In Kuwait, the example is that things can happen quickly. The rule of law will take time to get in place in Venezuela, but given the interim president Rodriguez is met just recently with the energy minister, the secretary of energy. In the United States, went down there. They went to a Chevron field that's producing 40,000 BOEs a day. And Chevron's CEO at that moment said, we could produce 7 times production from this field if we rebuild the infrastructure and if we have the rule of law. And that was in front of the interim president, Rodriguez, and in front of, the secretary of energy. So I think that we may see if the law is changed in the legislature in Venezuela, and then the continued progress is made, like we're seeing with the United States saying diluent can go in, the drilling industry can go in, the companies can say, okay, we're going to start moving. It may not be the big multinationals at first, even though Eni and Total and others are saying they're going to go in there. Marcel and Prom, others talking about going in. But it might be the wildcatters of Texas who are the more risk tolerant that go in. And they may go in and say, give me a small field. Let's do a deal. Let's do a royalty that makes sense. And we'll bring in under the auspices of the United States government, we'll bring in our people, we'll train people, we'll bring rigs in, and we'll get at it. And of course, when you get that Texas mentality of go, hit the, it's not slow on the gas pedal, it's pedal to the metal. That kind of action by the wildcatters could make a difference on Venezuela. I think that is a positive for Venezuela, a positive for the U.S. Gulf Coast, because they get heavies that are closer in distance, so they save on shipping costs. But it does mean that the Premier Danielle Smith has a concern that it may be 1 year, it may be 3 years, it may be 5 years, depending upon the speed that Venezuela goes. But the reality of it has changed, and Venezuela is, if you remember, Venezuela was shipping 3.5 million before Chavez, and they were all of that was going into the Gulf Coast. And Canada was shipping maybe 1 million. Now we ship 3.5 million. That 2.5 million increase was mostly heavy oil. So we displaced Venezuela, and now that return is going to happen where Venezuela could displace Canada. And that's why we need to have access to the Asian markets or European markets where they can take our Western Canadian heavy crude and process it in their refineries.
So if we take those potential production projections from Venezuela on the most optimistic side, is that going to be bearish overall for the oil price, or is that not enough to move the needle in the face of current demand?
Well, there's two things to think about. If demand grows by 1.2, 1.3 million a year, we're not even finding half that. So this year, the big increases are Guyana, Brazil, a little US, and a little Canada. So that's really where it's coming from. So we're not replacing it. The other way to look at it is worldwide depletion. If you look at the Permian and the Montney, it's 50% depletion in the first year. But globally, because you have long life reserves in the Middle East, in Saudi Arabia particularly, the oil sands are long life reserves. The industry, the numbers, nobody seems to have a good feel for it, but they say it's between 5 and 8%. If you take 5%, the lower end, on 106 million barrels a day, you've got to come up with 6 million barrels of production, new production every year. We're not spending enough to even replace 3 million. So that's the bullish story. So Venezuela's increase in capacity is going to be needed if it takes 2, 3, 4 years, we're going to have demand up by 4 to 6 million in that time. So it'll be easily taken into the world production, capacity, and the refiners are there to handle it. If they had a different quality crude that wasn't able to be processed, that would be a different issue. But they used to sell everything into the Gulf Coast. Getting back into the Gulf Coast is their main market. But China spent a lot of money, in the country. They're going to want to get some of that oil because they have refineries that can take it. And then, of course, Cuba's the one that's, lost out here because they used to get, oil from Venezuela in return for them providing doctors and the intelligence services and the security people that were around Maduro. And when there was, casualties, they were the ones who were the casualties, not so much Venezuelan security forces. So, look, the bottom line is Venezuela is a potential new entrant with decent volumes, but we will need those volumes. And the question is, those volumes will be needed to slow the increase in the price of oil, because the price of oil right now, Harold Hamm from Continental Resources says, I'm not drilling another Bakken well at $65. The economics aren't there. President Trump is saying, I want $50 oil because he wants cheap gas prices for the midterm elections. The problem is the industry is saying, hey, we can't do that. We need to have an economic rate of return. If you go to the Federal Reserve of Dallas, they have a slideshow there. They show every basin in Texas, and the average price that's needed is $65 just to break even. And of course, you don't want to break even, you want to make money. So the industry is going to need 75, 80. We're using in our numbers $70 WTI for the average in 2026. We're looking for a range of 54 to 68 in Q1. Then we're looking for prices to start moving up in Q2 because as OPEC proves, they do not have the ability from field production to raise the numbers. There's arguments that Saudi Arabia could produce 12 million barrels a day. They cannot do it from the field. They have never produced more than 10.5 million from the field. And the production they did in January was 10.9 million barrels from the data that I got right in front of me from OPEC's monthly. So they can produce more if they sell from their storage tanks onshore and their on the sea inventories. But if they do that in 30 to 60 days, they don't have that excess inventories to produce a 12.5 million. So yes, could they produce a 12.5 million? Yes, but not from field production. And that's really the thing to matter, field production.
Great summary. I want to home in on Canada for a moment here, because you mentioned that the new administration has more of a favorable bent towards not only the oil and gas sector, but towards mineral resource extraction in general. However, there is some concern when Mark Carney gets on a microphone and starts talking about how we need to go to net zero and we need to, reduce our dependency on fossil fuels. We need to electrify the future, green energy, all of these things that a lot of these political leaders say. However, do you think that that's perhaps him appealing to his voter base, paying lip service? A lot of the people who voted for him are kind of on the more environmental bent of things, whereas in reality, he's looking at it from a more practical standpoint that we need to increase oil and gas production in Canada. Because some people believe there's a geopolitical risk in the Canadian oil industry. What are your thoughts there?
Well, under Trudeau, there definitely was a geopolitical risk, and he was, environmentally unfriendly to the industry. He brought up the, carbon capture, but and then the cost of carbon was going to go up sharply. But I think, if you look at Carney's history, he was an environmentalist. He was anti-fossil fuels. But I think going into office and getting into that prime minister's office and realizing, Canada's pie is built on resources. The wealth of Canada is built on resources. So if you want to have more tax revenue for social services, for more environmental things that you want, you need a bigger pie. Well, manufacturing autos in Ontario is not going to do that. So is it going to be fisheries? No. So it's got to be the industries that have done it traditionally, be it forest products, be it mining, and of course the biggie is energy. And so coal has gone off is gone away, Canadian coal, unless it's metallurgical. And so, you want more copper, you want more natural gas, you want more oil. So the one that's the cleanest, and even his environmental leftists are willing to accept, is natural gas. And that's why, the coastal line is important. We've got Cedar moving forward. We've got Kissimmee moving forward. Right now, the only production is LNG Canada, maybe a BCF. They're ramping up the second BCF, so there'll be 2 BCF by the end of Q2 under the forecasts that we see. They have the ability to go to a phase 2, which would add another 2 BCF. That would need to get that approval from the government. But then you take in the other ones that are out there. We could be 6 BCF by the end of the decade. Now, let's put that in context. The industry in Western Canada produces 19 to 20 BCF. 6 on 20 is a big growth number over the coming years. And remember, you got depletion. So you've got to drill a lot just to offset depletion, and then, of course, to meet the new 6 BCF of demand. So it's a growth industry. And so our favorite stocks, number one, are natural gas. Then the second one is natural gas, and then liquids with natural gas. So, a lot of the companies do that. Some of them have natural gas, but with also oil, part of the Montney-Duvernay trend. We also like light and medium crude. Where I'm cautious on is the heavy crude, because I really do believe that Venezuela is a long-term threat to the Canadian energy industry if there are no pipelines. And it would mean that there would be no growth of greenfield. There would be no expansion of the oil sands. There would be SAGD would be limited. We'll fill TMX and maybe some TMX expansion. Yes, there might be a little bit with Enbridge. Yes, there might be rail, but it will never be as much as what we will lose to Venezuela in the Gulf Coast. You could argue that maybe we ship our oil down there and then they move it into the export markets. But just the cost of transportation would mean Canada is not an economic alternative versus buying from Venezuela or other countries that have heavy oil, because we're moving it from Western Canada down to the Gulf Coast, then, by sea. All of those transportation costs, and if shipping costs have gone up so much, recently for cargo, for VLCCs. And so I think that any argument we make that we can find alternative export capacity really requires a pipeline. Anything else than that is just minuscule relative to the loss of market share down south.
Well, I'd love to dive into where you're seeing the most opportunity in the energy space right now. You mentioned that you're very interested in natural gas and LNG focused companies. Maybe you could explain a little bit more about that, and also any other areas of the market. Obviously there's so many different areas of the energy space, including ancillary services like oil field services and sectors like oil tankers. Where are you seeing the most value at present when it comes to the energy space?
I think you can look at every area. When we divide our research, we have three client bases. One are conservative, older people who want dividend income and capital gains. So we try to find names where there's a 4 to 7% dividend yield, and you can find those out there, and we can talk that later, plus a 15, 20% capital gain. That's what we look at for that group. Then you have growth investors. They want some dividend maybe, but the real thing is they want to see growth in production and that the stock price goes up because they're producing more. And if the price of oil goes from 60 to 80 to 90, then the NAV goes up, cash flow multiples go up, and you get a big home run there. The last group is we have more, let's just say, entrepreneurial investors, and we call them the entrepreneurial group of stocks, where the people are looking for the home run. So they're looking for companies that are exploring that if they're successful with the drill bit, the stock will go up significantly. So if you take the price, right now we're trading at 2 to 3 times, depressed cash flow. At market peaks like 2008 and 2014, we were trading at 8 to 10 times cash flow. So you go from 2 to 3 to 8 or 10, but that's on the current commodity deck. You then take the commodity deck from 65 to 85 or 95. That means your cash flow goes up. Then if you have more cash flow and you grow production, that adds to it. So that's why this sector, if you want to pull any stock that you want, that you own today or that you're thinking about, pull out the charts from 1999 to 2008, and you'll see a lot of 10 baggers. And that's really the opportunity. Yes, we've gone up a lot in the last year, and stocks have doubled from the April 2020 low. But this is, if you look on a golf analogy, we're on the third hole. There's still a lot of golf to play, and there's there's going to be corrections along the way. Just pull out CNQ from 1999 to 2008. Again, a lot of the companies we talk about today weren't around in that period of time. You can't say, Tourmaline was around because it wasn't, because Mike Rose had Berkeley and then Duvernay, and now he has Tourmaline. So to me, go back to history, let history tell you the story. And to me, the upside opportunity is fabulous. Use corrections to be buy. Our group and my team on the research side is to tell you which companies are very good companies. And then we tell you, and we try to give you ideas of when they are attractive to buy on these corrections. And in April of last year, we had that. We sent out an actual buy twice on April 4th and April 7th. We added a lot of new names, and a lot of those stocks did exceedingly well. I'm waiting for a correction right now. We're overbought. The sectors, because of takeovers, we had New Vista takeover, we had Kuwaitno taken over, we had Step takeover. So everybody's playing who's next. The reality is we're very overbought, and I'll be writing about that in our Schachter Energy report that goes out to clients next Thursday. I'll be working on that in the next few days to finish it off. And we're also starting the run of 2025 results. We've had a number of companies already report their year-end results. We'll be writing those up. And in the next 2 or 3 issues, we'll cover all 32 companies that we cover, all the way from the biggest being Tourmaline to something like a Southern, which is a couple thousand BOEs a day. And so all of that will be available to our client base. So then they can decide, okay, I like this company, and now I'll wait and be patient for the buy signal. And when we go from overbought to oversold, like we do all the time, markets move around, on the roller coaster. We're overbought, we'll go to oversold. And when you get those signals, we do it. The 3 we watch for the buy signals are: 1, the price of oil gets depressed below the economics. So anything below $60, proves that point. Federal Reserve Dallas says it's 65 for Texas. Let's say 60. Second one we look for is a correction in the S&P TSX Energy Index. Right now, it's had a kind of a parabolic move. It needs to get oversold. That takes that can take a month, or it can take 2 to 3 months. So we're thinking sometime late March, April might be the window. And last year, the window was late March, early April. And if you go through history, interestingly, the most number of bottoms have occurred in March, April. You go to 2009 after the financial crisis, you go to 2020, during COVID. And then the other time is usually tax loss selling. If you've had a real bad year in the market, that mid-November to mid-December period is the second cluster of bottoms. But the biggest cluster is at March, April. So we're looking for a correction here. We're right now saying to people, get your buy lists ready, depending upon your risk tolerance. Sit down with your investment advisor. Are you a dividend income? Are you growth? Are you an entrepreneurial investor? I like all areas. Because I'm, older and we need income, over half of my portfolio is conservative. But I do have growth and I do have entrepreneurial investments because, we still are going to live a number of years, and you want to have exposure to growth and more importantly to entrepreneurial, because if they're successful, that's where your 10 baggers are going to come from. So we look at all of that. We provide that information to our clients. We do quarterly webinars. So the next one is going to be next Thursday evening. We do them for 90 minutes from 7 to 8:30 Mountain Time. And then people can send in questions about themes that they are interested in, and we have a give and take with them. And then the other thing we do, which is really differentiating us, is not only do we cover 32 companies, but we do once a year a conference called the Catch the Energy Conference. And for the companies, they spend a lot of time and money on institutional marketing. They go on roadshows with the bank-owned firms and the big energy brokerage firms, but they don't do much to individual investors. So when we created the product in 2017, we said, let's get a conference where the individual investors can sit down and talk to the management and the companies that they own. And the companies, it's not the IR people come mostly, it's the CEOs that come. So it's a Mike Rose does show up there from a Tourmaline. You do get Birchcliff, Chris Carlson showing up. So they are there to talk to the investors because this is the only opportunity they have every year to sit down with high net worth individual investors who are interested in energy. And so that's really how we created our product. It's been very successful, and we have a nice team putting it all together. And if your listeners are interested, just go to our website, and I know you'll send them that information. They can see some of our historic research, not the recent stuff, but historic. And then they can see stuff about our conference. There's a video there done by the TMX, which is our major sponsor. And then they can see what happens at the conference. And if they're able to come to Calgary on October 17th, Saturday, October 17th of 2026, we'd love to see them come. And they will have a chance to meet the companies, a lot of companies, and hopefully a lot of companies that they own.
Great. Well, for viewers of this podcast and YouTube program, we're offering $100 off the first year of subscription to the Schachter Energy Report. Use the code POD100 to get your discount. Josef, this has been a fantastic conversation. Any final words you'd like to share on the energy space and things that investors should be focused on there before I let you go?
When we do in our research is we cover both the opportunity from the point of the land base and how good the upside is from the physical side. We also cover insider ownership. We want management to have their money in before ours. We want strong balance sheets. So what I would say to the investors is, even if there's a company that we don't cover, go to the websites. They have presentations updated regularly. A lot of the companies will have a webcast when their quarterly results are coming out. And the thing that I listen to most is the Q&A at the end. What are the analysts and the institutional money managers wondering about from the company, and what are they doing? So there's so many ways that individual investors can be kept up on stories they own versus what it was 10, 20 years ago. Modern technology and the way IR has turned, where it was only available to the analysts, it was only available to the big institutions. It is now turned and democratized, where individual investors now have a more equal access. And so if you own a name, definitely spend the time owning it. If you bought a house, you'd spend a lot of due diligence checking the house out, getting an engineering report. Do the same attitude and take the same approach to your investments, because if you want them to grow into your retirement and provide you the income and and wealth transfer you want, you need to spend the time on doing it. And I think that energy is one area you should have in your portfolio. You and I may have a higher interest because we are interested in commodities. Other people, let's say in Ontario, may have a small weighting in energy, but there's opportunities right across the board, be it, defensively, royalty incomes. We cover Topaz and Freehold. You could go into high dividend yielding stocks with 7% yields like Surge and, other names like that, Whitecap. So there are opportunities with high dividend yields. And if you get you 10, 15% capital gain, that's not a bad, opportunity on compounding. So for the conservative investors, we got ideas, and then for the growth and entrepreneurial as well. And I think this is something that people should, if they've done very well in the precious metals, how quickly things can change. For years, gold was doing better, and then all of a sudden, the stocks woke up. Silver was lagging, and then the stocks woke up, and then silver took off. Energy right now, because we're 60, 65, people are saying, well, it's cheap. Maybe it's the next commodity. But when we have a movement in oil, and it can happen over 3 to 5 years, we could go from 65 to north of 100. And my prediction is the high nominal in 2008 was 147 US a barrel. I believe we'll exceed that before the end of this cycle and potentially even beat 200 a barrel. So we are, just like the toric and the parabolic move you've seen in the other commodities, we're waiting for ours.
Great. Well, as mentioned, there'll be a link in the description below to the Schachter Energy Report. Use code POD100 to get $100 off the first year of your subscription. Joseph, it has been an honor to have you on the show. Thank you so much.
Happy to be with you, Jesse, and I'll look forward to, if you want to do this again once a quarter or whatever, don't hesitate to reach out.
Thank you for joining us today. Our sponsor, ARC Silver Gold Osmium, has some great prices on silver bullion products. They are on your screen right now. These are well supplies last and subject to change. So reach out to owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you, and make sure to represent sound money in style with the exclusive Commodity Culture Stack Silver, not Fiat t-shirt. Buy one now using the link in the description below, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.